and today we're going to be having a look at Tesco's real estate strategy from 2005-2006. I find this case study particularly interesting given the recent debacle and troubles that Tesco is having with its accounts right now. So before we begin, we need to kind of put this whole case study in context. Why is this an important case study? Well, essentially what the case study is showing is how Tesco utilizes property portfolio to extract value, and it did this using a mechanism called sale and leaseback. What does sale and leaseback mean? Well, this means that the company can sell all of its property or part of its property portfolio to a third party who will then lease that property back to the person who sold it on specified terms. And how does this extract value? Well, essentially what happens is you are paid the full price for the property at market value at that particular point in time. So you get 100% value out of your asset, the property. And also another way of thinking about this is if you have a property, the yield on it is usually like between 6 to 8%, whereas if you transformed that property into cash and reinvested the cash into the business, which could be selling groceries, making shoes, anything, then what will happen is you will get a 20% return back on that same value instead of a 6 to 8%. So it's the idea of freeing up, extracting value from a property, freeing up capital, using it in something else that's higher yielding, and essentially generating profit, so maximizing your property portfolio. So what was Tesco's real estate strategy from 2006? Well, it basically wanted to retain control of the properties. That was very important to Tesco. And the reason why it's important is because other firms who embark on this sale and leaseback deals, control isn't as important as it was to Tesco, in that you will see that it dictated the way in which sale and leasebacks were conducted. So they wanted to do two things. They wanted to retain the control and maximize the value. So the whole point of doing it was to get the money out, but they didn't want to do this at a cost of losing control. So what happens is the more you try and keep control, well, the amount of value you get out, that will reduce. There is a trade-off between control and value. So hopefully you understand the idea of what I'm saying, the trade-off between control and maximizing value. What I'm saying is because if you put something into a leasehold, it's the landlord that has a control that dictates the terms, that will be in charge for furnishing, repairs, etc. It's not you. You won't, the way the property is, the general management, it will all be transferred to landlord because they're the owner. You're just a tenant. You're paying rent for the use of the property. I just thought I'll clarify that. So traditionally, sale and leaseback was a great way. You got your 100% value, but you did lose your control, your absolute control over the property. And so you must be thinking, how does this make sense? Why would Tesco embark on this when clearly in their business strategy the first thing was retain control of the property? Well, they did something very innovative and unique. They went through a process called joint venture, which is similar to a sale and leaseback, except the company will retain 50% of the stake in the property being sold, and the other 50% will be sold off to this third party and then leased back. So, and Tesco said, what did Tesco have to say about doing a joint venture scheme in its property portfolio? Well, they said the idea was to release funding for its future growth because it wants to be the #1 grocer while maintaining flexibility to operate and adapt its property assets. So it's very, very pushy on, they want to manipulate their assets. So what was so innovative about it? Well, essentially they managed to get control in a scheme which traditionally would have come across as you lose control, and they also retained the option of buying back that 50% share. They managed to negotiate that. They managed to add in a substitution clause to give even more flexibility. And what is substitution clause? Well, basically it's the idea that they were saying if at the end of the lease they don't want to give that property anymore, they can substitute in for a different Tesco property. they can just substitute. Increases flexibility if they decide they want to develop, I don't know, the Portsmouth store, and then, you know, they don't want to give it out anymore, they might just replace it with the Leeds store. So that was very good. And of course, having 50% of interest in the property means that you do get a 50% off the reversion at the end. You don't lose the future value as you would do in a traditional sale and leaseback. What's interesting also about this example is that you can see here how the real estate, how the property strategy is driven by business goals and business strategy. That's the idea. Property is something that can be manipulated and maximized so as to be in line with your business needs. And Tesco's needs were specifically control, and which it managed to get because it tailored the way it did the sale and leaseback, i.e. through joint venture, in a way, you know, that worked for them. So in sum, what was the main aim or goals of the sale and leaseback deals? Well, they wanted to release the money so as to expand their business to become the largest grocer. They did that, yes. Then they also had a long-term strategy which seemed to originate from their finance or accounts department, that 80% should be freehold, 20% should be leasehold, and that 20%, let's do it through sale and leaseback or joint venture, what we've just been discussing about. That was the aim, that they want to get to this ratio. What's interesting is nobody actually knows what is the basis of having this ratio, whereas there's actual academic papers and studies showing that ideal ratios are 65% freehold and 35% leasehold, but this is saying 80-20. We don't know where this values come from, but at the time that was the particular ratio they were after, so they were being advised. Before concluding, it's interesting to think about their strategy back in 2005-2006, because now they're in trouble. They've got a big hole in their profits and they need some way of raising capital so as to keep stability in the share price. And because the share price has fallen so low, they can't exactly do a rights issue, and if they were to issue bonds, which anyway probably wouldn't work in this kind of environment, you would only get 60% of the value of the asset, whereas if you do sale and leaseback, you sell your property, you get 100% of the value of the property. So would they possibly think about doing this? All the articles I read from Telegraph, Guardian, etc., they all basically say that they want to sell off and start utilizing their property portfolio because it is just so vast. And, you know, do they really need it? Is it surplus? And how much control do they really need? Anyway, thank you for watching. I hope you enjoyed.